Imagine waking up and overnight, the world you thought was safe has turned upside down. Your home value slashed. Your 401k cut in half. The bank you've trusted your whole life gone. This wasn't just a bad day for the market. This was the moment the global financial system stopped breathing. And here's the part no one saw coming. It didn't start with a war. It didn't start with a natural disaster. It started with belief. Believe that home prices only went up. Believe that risk had been eliminated. Believe that we'd built a game we could never lose. Today, we're pulling back the curtain on the 2008 global financial crisis. How the illusion was built, how it unraveled, and the little-known structure the wealthy used, and still used, to be protected from market crashes. It didn't feel dangerous. Not in 2007. It felt unstoppable. America was humming. Unemployment was low. The stock market was rising. And the housing market? It was a modern-day gold rush. Everyone knew the truth. Housing never goes down. It wasn't just a place to live. It was a money machine. From 2003 to 2007, home prices rocketed 46% nationwide. Credit was dirt cheap after years of rock-bottom interest rates. Banks and brokers weren't just lending. They were throwing money at anyone who asked. Lenders were approving ninja loans. No income, no job, no assets, no problem. The goal wasn't for you to repay. The goal was to bundle your loan into Wall Street's latest magic trick. Mortgage-backed securities, collateralized debt obligations, stacks of loans so complex, even many of the bankers selling them couldn't explain them. Credit rating agencies blessed these ticking time bombs with AAA ratings, the same rating as U.S. Treasury bonds, and sold them to pension funds, banks, and foreign governments. Everything looked good on the surface. But in reality, the danger was multiplying. Meanwhile, ordinary Americans were maxing out their leverage. Household debt hit 139% of disposable income. The biggest banks were worse, borrowing $30, even $40 for every $1 they actually had in deposits. It was a skyscraper built on sand. The psychology was pure euphoria. Fed Chair Ben Bernanke told Congress in March 2007 that the subprime problem was likely to be contained. Citigroup's CEO Chuck Prince put it bluntly, as long as the music is playing, you gotta go get up and dance. We're still dancing. And they were all dancing. But no one wanted to imagine how quickly the music would stop. At first, it didn't look like a crash. It looked like a dip. Early 2007, home prices stalled. A few subprime borrowers missed payments. Not a big deal, right? Then the drip turned into crack. Subprime lenders began failing. 25 companies gone in weeks. In August, French banking giant BNP Paribas froze 3 funds, admitting they couldn't value the U.S. mortgage securities inside. Translation in English? No one knew what they were worth, and no one wanted to find out. Credit markets froze. Banks stopped trusting each other. Overnight lending, the lifeblood of the system, dried up. In the UK, Northern Rock faced the first bank run in over a century. March 2008, the cracks hit Wall Street. Bear Stearns, an 85-year-old investment bank, collapsed under its toxic mortgage holdings. By the weekend, it was gone. Sold to JP Morgan for $2 a share, propped up by the Fed. But that was just a prelude. September 2008, a month of financial infamy. September 7th, U.S. seizes Fannie Mae and Freddie Mac, mortgage giants backing half of the nation's home loans. September 15th, Lehman Brothers files for bankruptcy. $600 billion in assets gone in the largest corporate failure in U.S. history. Same day, Merrill Lynch sells to Bank of America to avoid collapse. September 16th, AIG gets an $85 billion Fed bailout. September 25th, Washington Mutual fails, the biggest bank failure in U.S. history. The shockwaves were instant. A major money market fund broke the buck after holding Lehman's debt, sparking a run that threatened the short-term funding system every major business relied on. It wasn't just Wall Street. The plumbing of the entire economy was clogged. Stocks went into freefall. Retirement accounts, pensions, college funds, all plunging. By late September, Congress scrambled to pass the $700 billion TARP bailout. First vote even failed, and the Dow had its biggest single-day drop point in history. Denial was over. Fear was in charge. The mantra flipped from buy the dip to sell at any price, and the sell orders drowned the market. The crash made the headlines, but the aftermath was quieter, slower, and far more painful. When the dust settled, it wasn't just Wall Street bleeding. It was Main Street. Unemployment hit 10%. 8.7 million jobs vanished. Whole industries, construction, finance, manufacturing, got it. Home prices fell 30% nationwide. 3.8 million foreclosures from 2007 to 2010 turned neighborhoods into ghost towns. 1 in 4 homeowners were underwater. Household wealth down 13 trillion in a year. Globally, Europe fell into a debt crisis. Iceland's banking system collapsed. Trade froze. Even China, mid-boom, saw factories go dark overnight. The cruelest cut? It wasn't the gamblers who lost the most. It was the responsible ones, the savers, the steady workers, the families who did everything right and still watched decades vanish. The Great Recession didn't just drain bank accounts. It drained trust. It rewired a generation's relationship with risk. And for millions, that scar never healed. History doesn't repeat, but it rhymes. Since 2008, markets have soared. New fortunes have been made. Fear has faded. And step by step, the same patterns have crept back in. Today's headlines come with deja vu all over again. AI stocks explode. They'll never slow down. Bitcoin shatters 100,000. It can only go higher. New meme coin gains 1,200%. Get in before it's too late. On TikTok, YouTube, and Discord, self-made gurus pump the next big thing. Every scroll is another promise of overnight wealth. The same "it can only go up" mindset that fueled the 2008 housing bubble. Sound familiar? It should, because we've seen this movie before. In 2007, it was housing. In 1999, dot-coms. Now, it's AI, crypto, and meme stuff. The musicians change, but the music stays the same. Companies with no profits, trading like trillion-dollar empires. Teen traders piling in, convinced they found a shortcut to the top. A market running on belief, while risk is treated like a myth. And the old phrases are back. This time is different. We've eliminated the risk, and the old rules don't apply. Maybe they're right. Maybe the technology is revolutionary, but belief without structure? It's still just speculation in 4K. Here's the truth. When the housing market imploded in 2008, 13 trillion in household wealth disappeared. Retirement, college funds, and dreams evaporated overnight. But the wealthy didn't panic. They didn't dump assets at fire sale prices because they weren't standing on the same shaky ground. They had buffers, structures, escape hatches. While everyday investors watched in disbelief, the wealthy sat inside protection-first strategies, private assets, structured notes, dividend-paying whole life insurance. Not flashy, not speculative, just safe. And today, there's a modern tool most didn't have back then, one that blends market-linked growth with built-in crash protection. Index Universal Life, IUL. A properly designed IUL links your cash value to a market index without putting your money in the market. So when the market rises, you capture a share of the upside. When it falls, you have a contractual 0% floor, meaning your account never loses value from market decline. No margin calls, no panic selling, just stability in good years and bad. And with that right design, the growth can be accessed tax-free. No capital gains, no fixed income tax, no required minimum distributions. And that's why high-income professionals, doctors, attorneys, small business owners use IULs as their anti-Wall Street retirement plan. Because when the next crash comes, they're not hoping to survive it. They're built to survive. Most investors in 2008 never saw it coming. Even fewer had a way out. Now you do. Your next step? See exactly how this strategy could work for you before the next downturn makes the choice for you. Try the IUL Custom GPT, your private AI-powered strategist. It's going to answer all the questions your advisor wants. How much can I contribute? What happens in a bad year? How does it compare to my Roth or 401k? Ask any question, see real-world examples, and you can model your strategy in seconds. And the link is in the description below. It's instant, it's confidential, and it's built for people who want more than guesswork. The market's wheel will keep spinning. Make sure your future isn't strapped in. You can watch our next video, the 2020 COVID-19 crash, what really happened, and how to never be exposed again. Because history doesn't just rhyme, it warns. And remember, it's not what you earn, it's what you keep. Enjoy it.